Hello and welcome. Within this video I would like to explain to you what a hedge fund is and how it actually works. And I would like to focus on the actual structure that is used in most jurisdictions, and in particular I would like to explain the various components and stakeholders to the fund. So I made this drawing. So you see in the middle we have the vehicle itself, the hedge fund. Of course we have the chief investment officer, the trader, and also the team which stands behind him. So there may be analysts, there may be researchers, there may be execution traders, etc., etc. So we have a team which does all the trade decisions, which manages the fund, which applies a respective trading strategy to the markets. Then we have the investors in the fund. The investors provide investment capital, which is then used for the trading, and in return for providing the investment capital, they have shares in the actual fund. So if the team is successful and the fund has positive returns and there's profit, the value of those shares increases. In some structures there may be dividends, etc. And then of course we have the custodian, which is a bank most of the time where the money is physically placed, and then we have different brokers which may be used by the fund for the trade execution. So these are different parties. Normally, for example, if a new investor joins the fund, he pays in the money to the administrator. He gets shares in the fund in return, and physically this capital, once it's signed off, will be moved to the custodian, and from the custodian to the various brokers so that it can be used for trading. So the role of the administrator is quite important. Of course, the relationship between the fund and the administrator can vary from fund to fund, but in general the administrator provides the monthly NAV, for example, or even a more frequent or less frequent NAV. So actually this third party provides the value of the fund in a certain point of time, so that makes it possible to measure the fund's performance. And then we have a whole group of other stakeholders, of course. We may have legal advisors, accountants, administrators, back office, IT, etc. These are all very, very essential components to the vehicle, of course, especially in today's environment, since most funds are moving more and more in the space of quantitative trading in one way or another. Then of course there are other entities. There's a regulator, of course, there are competitors, there are counterparties to the trades. So this should give you a general overview of all these components and how they work together. So to summarize, the CIO, the Chief Investment Officer, is responsible for implementing the trading strategy. He often has a team behind him supporting him in this role. Tasks could be split up among different traders. In fact, the whole structure can differ from fund to fund. Sometimes there are so-called sub-cells to the fund which employ different trading strategies. Sometimes, one fund employs different trading strategies on one account or different accounts. All these things, of course, can vary from hedge fund to hedge fund. But generally speaking, those components will be there in one form or another, whether the fund is in London, New York, or in other jurisdictions such as Singapore, Dubai, Malta, Ireland, Gibraltar, etc. And it's important to understand that this is basically what constitutes the whole structure. So the administrator makes sure that, for example, transfers are conducted by a third party, that the net asset value is measured correctly, and then this group of stakeholders may facilitate certain tasks, which sometimes can be complex, so that everything functions as it should and everything is clean. That there's a professional setup, there is a good conduct of different tasks. For example, when there are transfers, it's not that just one person can do transfers, but they need to be signed by different parties. And of course, the strategy of the fund could completely differ again. So there's a high number of different trading strategies. There is macro investing, there's long short equity, there is distressed debt, there is strategy focused on derivatives, and these days we have increasingly quantitative strategies, which means funds employing algorithmic strategies in the markets, where the trade execution could be completely automated to some degree or even completely. And the trend goes more and more towards those quantitative funds. Of course, the most notable and famous quantitative fund could be Renaissance Technologies by Renaissance Capital by Mr. Simmons. This is one of the best performing hedge funds in history as well. And of course, there are multi-strategy hedge funds as well. There are also funds of funds, which means these are hedge funds which then select other hedge funds to invest in. Now, I should also mention that there are some vital documents. For example, there is the so-called PPM, the Private Placement Memorandum. So this document constitutes, the most essential information on the fund. If an investor wants to buy shares on the fund, he normally gets handed out this Private Placement Memorandum and signs it. And then a subscription is implemented so that it's clear which kind of amounts the investor is going to provide to the fund, and how many shares he gets in return for his investment. What the general rules are. So is there a lock-in period? Can he redeem his investment? When can he do that? At which conditions? Can he invest more, etc.? Of course, another topic is always fees. So traditionally it was a 22 structure or 220, which means a 2% annual fixed management fee, which the fund uses to pay off a lot of fixed costs, as well as a 20% performance cut. These days, however, these values can differ quite a lot. They can be, in some cases, even higher, in other cases lower, 110, etc. Becomes more and more popular. Of course, the size of the fund itself, the account size or the assets under management can also differ a lot. There are huge funds managing several $billion, but there are also very small funds which just manage a few $1 million or even below. So you have all kinds of players in the market. It should also be noted that in general hedge funds are restricted when it comes to marketing. So if they have a website, it can only be reached with a login, etc. But they cannot do normal marketing as other firms, let's say, in TV or radio. This is generally not allowed by the regulator. Of course, this depends as well on the particular structure. In some jurisdictions they distinguish between small private funds and then, let's say, experienced investor funds, where there are additional boxes to tick. So, for example, licensed directors who are on the board and oversee the executives' actions. So yeah, this is a general summary of some of the relevant aspects. I hope you enjoyed it.